Thank you for joining me on today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra, and I would like to increase your financial IQ with today's discussion, which is about the very, very scary topic of IRS audits. Nobody wants to get audited by the IRS. The thought is anxiety-inducing for most of us. But note that business owners, the self-employed, and the wealthy have higher audit rates. These returns for these folks tend to be more complex, and so they get greater scrutiny from the IRS. Additionally, oftentimes these are higher income earners, so sort of like Willie Sutton said, why do you rob banks? Because that's where the money is. So the IRS is wisely targeting higher income earners. As an example, this statistics from a couple of years ago, but if you have $10 million or more of income, the audit rate is 4% for folks that fall into that category. Granted, that's an awfully small percentage of Americans that earn $10 million in a year. But as far as the example goes, if you're between 100 and 200,000, way more commonplace, the audit rate is well below 0.25%, which also reminds all of us that the chances of getting audited are generally very low for most of us. I did want to discuss with you today, though, the top four key audit triggers. And the first one I want to discuss with you, number one, is missing income. So the IRS wants you to report income, and you get reporting from any number of sources: employers, 1099 income, dividends, interest, royalties, alimony. The list goes on and on and on. There are lots of sources of income in the United States today. The IRS wants you to report that income. Know that many of the income senders, like your employer, they report to the IRS income that they sent out to you. And the IRS then cross-references what they get from various sources, what the IRS gets from various sources, and they match that against what you put on your tax return. So they're looking for missing income. They're looking for inconsistencies from what was reported to them from other sources versus what you reported to them on your tax return. Missing income is a very common tax evasion tactic. By the way, in terms of jargon, you're legally allowed to avoid taxes. Think about, I put money in a 401k, so I get a tax deduction that reduces my taxes. That's legitimate and legal tax avoidance. Waiting to sell an asset until the next calendar year to avoid taxes in the current calendar year, that's legitimate tax avoidance. What is illegal is tax evasion. And in terms of missing income, a good common example I think all of us can appreciate is think of a cash business or a cash transaction. You might think that if I pay this plumber or this construction person or this restaurant or service provider, if I pay them in cash, they may not report that income. Now, I'm not suggesting everybody is breaking the law and evading taxes, but common sense tells us that at least some percentage of folks are. That's an example of tax evasion, and that's part of what the IRS is looking for, is people that are purposely underreporting income. Problematic, though, is that many times it could be an innocent mistake. You might get a 1099 or some type of income report, and maybe it gets lost in the mail. Maybe you misplace it. Maybe you forgot about it. And so it doesn't end up on your tax return, and you are not doing the right thing, but it is inadvertent. It's a common innocent mistake that might trigger an audit. So be it. So the goal for you in tax preparation, and if you work with a professional tax preparer, one of their roles is to help you make sure that you report all of the income you are supposed to. So that's number one, missing income. Number two, IRS trigger of the four I want to discuss with you is large swings in income. This could be unavoidable. Sometimes especially small business owners, entrepreneurs, or commission-oriented compensated folks, you could have big swings in income. It can be unavoidable, but it's an audit trigger nonetheless. A good example of this, traveling nurses during COVID made tons and tons of money. It was a field that was in tremendous demand, and people that were willing to travel and work under difficult circumstances related to COVID, they oftentimes made a multiple of what they usually made. That might be an audit trigger, a red flag. So large swings in income. So if you have large swings in income, it's not necessarily that means that you did anything bad, but I would say it's a sign for you to be cautious about your tax return, maybe more diligent in preparing, knowing that this might be something that catches the IRS's attention. A sale of a business is another example of a big swing in income. You might be wondering, well, why would the IRS consider this a red flag? People make some money one year, make more the next year. All of us have had ebbs and flows in our income. The IRS thinks that this is a potential sign, large swings in income, a potential sign of unreported income. I don't necessarily agree with that, but that is the general consensus on why the IRS considers this an audit red flag. Number 3 is business losses. Now, if you work for somebody and you're not self-employed and don't have a Schedule C or receive 1099 reporting for income you receive, this might not apply to you, but business losses. It's expected if you start a business, you might have some losses in the early years as a business is stood up and gets going. When you start a business, you might have to put some money into business, might take you some time to get some customers, that sort of thing. That's expected. But business losses that occur year after year with a lot of regularity are considered a red flag. Why is it a red flag? Well, because you should be going into a business with the notion that you're going to make money. And if you consistently make money, you could question the economic value of putting time, effort, and money into such an endeavor that consistently loses money. So business losses is the third red audit flag I wanted to share with you. And the last one is questionable deductions. So we oftentimes on our return take deductions to reduce our taxable income. Earlier in the show, I mentioned 401k contributions. That's an example of a deduction. Questionable deductions, that's a little bit of a gray area. It means different things to different people, but I'll point out 3 examples for you. One is outsized charitable deductions. Large charitable deductions might generate some scrutiny. Number 2 is passive losses on rental property. This is for all of my listeners who are real estate investor enthusiasts. And lastly, home office deduction. This has been around a long time. If you're self-employed, you could take a home office deduction. Crazily, even though work from home and remote work is way more popular than it was years ago and generations ago, it's still a common audit flag. I guess it lends itself to people behaving badly and taking bad deductions. So those are some examples. If you have any questions about this, talk to your tax professional. You could talk to us here at Elliott Wealth Management Services. Although we do not prepare tax returns for our clients, we do spend a lot of time consulting with them so that we could mitigate and avoid taxes. Remember, avoiding is legal, evading is not. Helping our clients avoid taxes whenever and wherever possible within the construct of their overall financial plan and pursuit of financial security. So thank you for listening to today's episode of the Simply Financial Podcast. I'll be back with you on the next episode very soon. In the meanwhile, subscribe to the podcast and check out the work we do. Go to our website, elliottwealth.com. That's 2 L's, 2 T's, elliottwealth.com. Thank you.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, The information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.